Dividend stocks are a popular choice among investors seeking a steady income stream. These stocks can offer not only regular payouts, but also the potential for capital appreciation. With market volatility and ongoing uncertainty with interest rates, dividend-paying companies can add an extra layer of stability to an investment portfolio. Investors often turn to dividend stocks during turbulent economic times, as they tend to be well-established companies with solid financial foundations, providing a cushion against market fluctuations. These stocks have been selected based on their strong financials, attractive dividend yields, and potential for future growth. If you're looking for more portfolio growth, be sure to subscribe to this channel and leave a like. Let's dive into our first pick. This company is a giant in the biopharmaceutical industry and has made significant strides in treating various serious diseases. We're talking about none other than Bristol-Myers Squibb. Bristol-Myers Squibb is a leading global biopharmaceutical company that focuses on developing innovative therapies in oncology, immunology, and cardiovascular diseases. Their top-selling drugs include Revlimid, a cancer therapy, and Eliquis, an anticoagulant. Despite a slight revenue decline in 2023, the company is optimistic about returning to growth in 2024, bolstered by its strong product pipeline and recent dividend increase. In 2023, global sales of Eliquis rose by 3% to $12.2 billion, and Opdivo's revenue grew by 10% year over year. However, the overall revenue dropped by 2%. The company is projecting revenue growth for 2024 and has recently increased its dividend by 5.3%. One major advantage of Bristol-Myers Squibb is its attractive valuation, with a forward earnings multiple of 7.2, suggesting the stock is undervalued. Additionally, the company offers a strong dividend yield of 4.8%, which is appealing to income-focused investors. The potential for growth is further enhanced by the company's late-stage cancer drugs in the pipeline, which indicates strong future pricing power. On the downside, Bristol-Myers faces significant generic competition for its leading cancer drug, Revlimid. Moreover, Opdivo and Eliquis may encounter heavy generic competition after 2028. The company is also projected only modest revenue growth for 2024, which may concern some investors. Moving on to our second pick, we shift gears to a company that's been a cornerstone of the tobacco industry for decades. This company continues to offer high dividends despite market challenges. Let's take a closer look at Altria Group. Altria is one of the largest tobacco companies in the United States, known for producing cigarettes, cigars, and smokeless tobacco products. Its portfolio includes well-known brands like Philip Morris USA and John Middleton Co. Despite the challenges in the tobacco market and regulatory landscape, Altria continues to deliver strong financial results and has a high dividend yield, making it attractive for dividend investors. Altria has achieved a 5-year adjusted diluted earnings per share growth rate of 4.4%. Despite a challenging market, the company has maintained a quarterly dividend of 98 cents per share, translating to a 9.3% yield. One of Altria's key strengths is its high profitability, with a net income of $8.1 billion in 2023. The company has the ability to raise prices on U.S. cigarettes to counteract declining volumes, which supports its revenue growth. Additionally, Altria's efforts to diversify into other tobacco products help reduce regulatory risks. However, Altria faces a declining market for U.S. cigarette consumption, which could impact future revenues. The company's exposure to high-growth emerging markets is also less than that of some competitors, potentially limiting its growth opportunities. Furthermore, Altria is subject to potential U.S. regulatory challenges, including a possible ban on menthol cigarettes, which could negatively affect its sales. Last but not least, let's explore a leader in the petroleum refining industry. This company has made impressive returns to shareholders and is investing heavily in renewable energy. Here's a detailed look at Marathon Petroleum. Marathon Petroleum is a major petroleum refiner with operations in the Midwest, West Coast, and Gulf Coast regions. The company benefits from the crack spread, the difference between crude oil and refined petroleum product prices. Marathon also has a significant stake in MPLX, a company involved in midstream oil and gas logistics. In 2023, Marathon reported an adjusted net income of $9.7 billion and returned $12.8 billion to shareholders through dividends and buybacks. Investments in renewable diesel facilities position the company well for future growth. Marathon's diversified Gulf Coast refining facilities provide operational flexibility, which is a significant advantage. The company's investments in renewable diesel facilities are promising for future growth, indicating a forward-thinking approach. Additionally, high European natural gas prices could benefit U.S. refiners like Marathon in the global market. On the downside, Marathon's exposure to fluctuations in oil and gas prices through MPLX poses a risk. The company's West Coast facilities have higher operational costs, and there is potential demand threat from electric vehicles. Global regulatory risks related to carbon reduction initiatives could also impact Marathon's future operations. Now that we've covered the individual strengths and challenges of each company, let's dive deeper into an in-depth analysis and compare these stocks side by side. Bristol-Myers Squibb offers stability through its pharmaceutical revenue streams and potential growth from new drug developments, but it faces risks from patent expirations and generic competition. The company's robust pipeline and strategic focus on oncology and immunology give it an edge in the biopharmaceutical sector, though the looming generic competition could dampen its long-term prospects. Altria provides a high dividend yield and has made efforts to diversify in response to declining cigarette sales. Its high profitability and pricing power in the U.S. market are significant strengths, but the company contends with long-term regulatory and market challenges. Altria's strategic moves to enter alternative tobacco products show promise, but the declining cigarette market and potential regulatory bans are considerable hurdles. Marathon Petroleum delivers strong financial performance with significant returns to shareholders and future growth potential through renewable energy investments. Its diversified refining operations and investment in renewable diesel facilities highlight its adaptability and forward-thinking strategy. However, Marathon also has market exposure risks and regulatory challenges. The company's reliance on the volatile oil and gas market and potential cost increases from regulatory compliance pose ongoing risks. These three dividend stocks, Bristol-Myers Squibb, Altria Group, and Marathon Petroleum, offer promising growth and stability. Each has its own strengths and risks, but they all provide attractive dividend yields and potential for future growth. What are your thoughts on these stocks? Let us know in the comments below. If you enjoyed this video, please like, subscribe, and hit the notification bell for more investment insights.